Welcome to this session from the Skilled MBA Case Study Series, where we analyze real-world strategic business decisions. Today's case, Vanguard's Active ETF Dilemma, explores a critical decision faced by Vanguard in 2024. Should Vanguard enter the growing market of actively managed ETFs? As one of the world's largest asset managers, with $9.3 trillion under management, Vanguard must carefully consider the opportunities and risks associated with launching active ETFs while maintaining its reputation for low-cost, investor-first products. Let's dive in. Vanguard's decision revolves around three key strategic challenges. Market opportunity. Actively managed ETFs are a fast-growing segment in investment products. Brand identity. Vanguard is best known for low-cost index investing, and this move could impact its reputation. Strategic alignment. Any new product must fit within Vanguard's dual approach to index and active investing. Balancing these factors is essential to determine whether Vanguard should pursue, delay, or reject entry into the active ETF market. Several key stakeholders influence this decision. Rodney Comegys, Vanguard's global head of the Equity Index Group, leading the evaluation of active ETFs. Management team, responsible for ensuring alignment between new products and Vanguard's strategic goals. Investors. Their preferences, trust, and expectations will shape the success of any new product. Understanding these perspectives is crucial to making a data-driven strategic decision. To evaluate this decision, let's compare index and active investing. Investment type characteristics. Index investing passively tracks market indices, offering lower costs and broad market exposure. Predictable performance and minimal management required. Active investing seeks to outperform the market using research-driven strategies, but comes with higher costs and requires skilled fund managers. Vanguard's challenge is to determine if active ETFs can deliver consistent outperformance while maintaining its cost efficiency and investor-focused philosophy. Active ETFs differ from traditional mutual funds in several ways. Feature ETFs, mutual funds, trading. Intraday on exchanges, end-of-day pricing, liquidity, immediate access, next-day settlement, tax efficiency, generally higher, potentially lower transparency, daily holdings, disclosure, quarterly disclosure. These distinctions impact investor preferences and regulatory requirements, making the transition to active ETFs a complex decision for Vanguard. A fundamental rule in active investing is the iron law of active management. Active managers must generate enough excess returns to justify their higher fees. Potential for outperformance. Skilled fund managers can beat market returns. Cost-performance balance. Higher fees must be justified through consistent results. Fee structure. Active management commands premium pricing. For Vanguard, entering active ETFs means proving it can generate enough value to justify higher costs, a significant challenge in a cost-sensitive market. Vanguard has several key strengths that support active ETF expansion. Industry leader, strong presence in both index and active investing. Trusted brand, known for low-cost, high-value products. Massive AUM. Managing $9.3 trillion provides financial strength for new product development. These strengths position Vanguard to capitalize on active ETF market growth, but do they outweigh the risks? Despite these advantages, Vanguard faces key weaknesses. Brand perception challenges. Launching active ETFs may confuse investors about Vanguard's core mission. Operational complexity. Managing daily disclosures and intraday trading differs from traditional index funds. Learning curve. active ETFs require a new infrastructure and strategy. These weaknesses highlight potential risks in Vanguard's strategic shift. If executed correctly, active ETFs offer several growth opportunities. Expanding market. Active ETFs are a high-growth investment segment. New customer segments, reaching investors seeking active management. Product diversification, offering more choices to retain and attract investors. By leveraging these opportunities, Vanguard could expand its product range without diluting its brand. However, the active ETF market also presents significant threats. Established competitors, firms like ARK Invest and JP Morgan, already dominate active ETFs. Brand dilution. Moving into active ETFs may weaken Vanguard's cost leadership reputation. Market volatility. Active ETFs are highly sensitive to economic shifts, which could impact performance. These factors could limit Vanguard's success if not carefully managed. Vanguard has 3 strategic options. 1. Full market entry, launch a comprehensive suite of active ETFs. Pro, captures market growth. Con, high risk of brand dilution. 2. Maintain status quo, focus on existing strengths and avoid active ETFs. Pro, protects brand integrity. Con, may miss market growth opportunities. 3. Selective entry, introduce limited active ETFs, testing the market. Pro, balances risk and reward. Con, requires careful execution and monitoring. A well-structured selective entry strategy may offer the best path forward. The active ETF market has shown significant growth within the broader ETF industry. Active ETF assets have steadily increased, reflecting investor demand for actively managed products with the flexibility and efficiency of ETFs. Total ETF market growth continues to expand, with active ETFs representing a growing share. For Vanguard, this trend presents a strategic opportunity, but also raises the question: should Vanguard capitalize on this momentum, or does this move conflict with its long-standing brand identity? A careful market entry strategy is required to navigate this expansion effectively. Vanguard must evaluate its position within a diverse competitive landscape. Market leaders. Established firms like BlackRock and JP Morgan, which already have a strong active ETF presence. Emerging players. New entrants offering innovative active ETF strategies, such as ARK Invest. Traditional firms, large asset managers transitioning from mutual funds to ETFs. Specialized boutiques, niche firms focusing on highly targeted active ETF offerings. Given these competitive pressures, Vanguard must differentiate itself while preserving its core strengths. Understanding investor behavior is critical for Vanguard's decision. Survey data highlights key investor priorities. 65% prioritize cost sensitivity. Low expense ratios remain the primary decision factor. 42% focus on performance, actively seeking above-market returns. 78% value brand trust. Investors prefer established, reputable firms. 53% consider tax efficiency, favoring ETFs over mutual funds for tax benefits. Vanguard must ensure any move into active ETFs aligns with these investor expectations to maintain trust and demand. Expanding into active ETFs requires major operational adjustments in 4 key areas. Product development, ensuring new ETFs align with Vanguard's investment philosophy. Regulatory compliance, meeting SEC requirements for disclosure and transparency. Trading infrastructure, establishing systems for intraday trading and liquidity management. Marketing strategy, effectively communicating the value of active ETFs to investors. Each of these factors plays a crucial role in Vanguard's ability to successfully enter the active ETF space. A key challenge in launching active ETFs is managing Vanguard's brand perception. Current perception. Vanguard is recognized for low-cost index investing with an investor-first approach. Transition period. Introducing active ETFs may cause initial skepticism among investors and industry analysts. Future positioning. If executed successfully, Vanguard could be seen as a comprehensive investment solutions provider across both passive and active strategies. Maintaining trust while expanding offerings will be essential for long-term success. Based on our analysis, the best strategy for Vanguard is selective launch. Introduce a limited set of active ETFs focused on areas of strength. Performance monitoring. Track market reception and investment outcomes before scaling further. Strategic expansion. Expand offerings gradually, based on investor demand and success metrics. Continuous evaluation. Regularly reassess the strategy to ensure alignment with Vanguard's core values. This phased approach allows Vanguard to test the waters while mitigating risks to its reputation. Vanguard faces a strategic opportunity in the active ETF market, but must balance growth potential with brand identity. A selective, phased entry allows Vanguard to expand cautiously while preserving investor trust. Success depends on maintaining Vanguard's core principles: low costs, transparency, and an investor-first approach. By adopting a disciplined, data-driven approach, Vanguard can capitalize on market growth without compromising its reputation. Thank you for joining this session of the Skilled MBA Case Study Series. We now open the floor for questions and discussion.